Hi and welcome. This is the latest market update and I wanted to share with you really what's been going on in the share markets over the last month since the last update. The key things to understand is we never really got that Santa rally, which for the last 12 to 15 years we've always had. The share markets just got worse and worse and worse as we headed into Christmas. Why was that? And I've spent a lot of time talking about these issues. Obviously the trade war between the US and China, and we also have a huge degree of instability coming out of Brexit. There is also some key concerns now with the US government shutdown continuing, that will significantly look to erode first quarter growth in the United States. So it's a number of different things which are causing the current share market volatility. Are there opportunities still? Absolutely. Are there things that I'm constantly looking at around what positioning we can be doing in the market? Absolutely. So the key things to understand are where we are in the share market today is absolutely lower than where we were 12 months ago. Every single one of you would have heard me say during client meetings, the level of return that we've enjoyed over the previous 3 to 4 years was never going to continue, and to expect much lower levels of returns moving forward. So where we are right now basically takes particularly the Australian share market back to where we were in April, realistically almost February of last year. So when we're looking at our superannuation statements for the last 6 months, we're basically looking at where it was coming off significant highs to where it was at its lows. The market has recovered a little bit at the beginning of this new calendar year, but is really genuinely a case of keeping a very close eye on what is going on with Brexit, what is going on with the US tensions between and trade wars between China and the United States and the longer term impact of that. But thirdly, the unexpected piece and why we didn't see that Santa rally realistically comes down to the US government shutdown now being the longest in US government history. What that means is proportionately 800,000 people in the US employment market is not that many to not be receiving a paycheck. But if we start to see that slight erosion of those people's ability to spend, and it's not just their ability to spend, it's their family's ability to spend and the community around them's ability to spend, we will see a lower level of economic growth than what we expected from the United States, which will create some jitters. China still remains a concern with the levels of debt that they have, and there is a general consensus in the market that their economic growth is also definitely slowing. But the biggest issue that we need to get resolved right now, and would see a significant recovery in the market, would be if the US and China can agree to a way forward from a trade point of view, and it does look like there are some positive moves in that direction. The US government obviously reopening and business as usual taking shape. And obviously with the Brexit situation, them finally being able to find a satisfactory situation in relation to the backstop, so that all parties can actually begin to move forward. So that's where we're at. As always, if you've got any questions, make sure you email me or pick up the phone. But I am going to be making some changes to portfolios over the coming months, and I'll be in contact with you if it is one of your portfolios that changes need to be made to. So I'll speak with you soon. Thank you.